Before we dive in, please remember that I am not a financial advisor, and this video is for educational and informational purposes only. The information presented here is not intended as financial, legal, or tax advice. Investing involves risk, including the potential loss of principal. Always do your own research and consider consulting with a qualified professional before making any investment decisions. You open your 401k statement, or maybe it's an IRA or a brokerage account, and you see it. A list of names that sound like a foreign language. The Fidelity Blue Chip Growth K6 Fund. The Vanguard 500 Index Fund Admiral Shares. The T. Rowe Price Midcap Value Fund. You know your money is in there. You see a number and you hope, you pray that it's bigger than the last time you looked. But if someone put a gun to your head and asked you to explain what the American Funds Growth Fund of America class actually is, you'd be in trouble. You are not alone. For tens of millions of hardworking Americans, this is the reality. We're told to save for retirement, to invest in our 401ks, but we're handed a map written in code with no key to decipher it. Feels like a secret club and you were never given the password. Well, consider this series your key, your all-access pass. My promise to you is simple. Over the next several parts, we are going to demystify this world completely. We are going to tear down the wall of confusing jargon and replace it with simple, powerful understanding. By the time we are done, you will not only know what a mutual fund is, you will understand how they work, how to tell the good from the bad, and how to choose the right ones to build your wealth and secure your future. You will go from feeling confused and intimidated to feeling confident and in control of your financial destiny. Because let's be clear, this isn't just about numbers on a screen. This is about your life. This is about having the freedom to retire when you want, not when you're forced to. It's about being able to pay for your kids' college, to buy that house, to travel, to live without the constant grinding stress of financial worry. The single greatest wealth-building tool for the average American over the last 70 years has not been some secret stock pick or a speculative bet. It's been the humble, often misunderstood, mutual fund. And it's time you learned how to wield that tool like an expert. So let's start at the very beginning. What on earth is a mutual fund? Forget the confusing definitions for a minute. I want you to imagine you're going to the grocery store. Your goal is to make an amazing, healthy, delicious fruit salad. The perfect fruit salad needs variety. You need apples, you need bananas, you need oranges, some strawberries, maybe some blueberries and grapes. Now you have two options. Option 1. You can drive all over town. You can go to one farm to buy the absolute best apples. Then you drive 20 minutes to another farm that specializes in organic strawberries. Then you go to a third market for the best oranges. This is a ton of work. You have to research which farms are the best, spend time and gas driving to each one, and you have to buy a whole bag of apples and a whole carton of strawberries, even if you only need a few of each for your salad. It's expensive, it's time-consuming, and if you accidentally pick a bad batch of apples, it could ruin your whole salad. This is like trying to build an investment portfolio by buying individual stocks. You have to research Apple, then research Google, then research Johnson & Johnson, then Ford, then Coca-Cola. You have to buy shares of each one individually, paying a commission each time. It takes a massive amount of time, knowledge, and if you pick one or two bad companies, the financial equivalent of a rotten apple, it can devastate your entire portfolio. But there's another way. Option 2. You walk into the grocery store, and you go to the prepared food section. And there, sitting in the cooler, is a beautiful pre-made fruit salad. A professional chef has already done all the work. They went to all the best farms, they picked the freshest fruit, they washed it, chopped it, and mixed it all together in the perfect proportions. In one single container you get your apples, your bananas, your strawberries, your blueberries, everything you need. You just grab the container, put it in your cart and check out. It's convenient, it's simple, and you get instant variety. That pre-made fruit salad, that is a mutual fund. A mutual fund is simply a company that takes money from thousands of investors, people just like you and me, and pools it all together. It's a giant collective pot of money. Then a professional money manager, our chef, takes that giant pot of money and uses it to buy hundreds or even thousands of different investments. They buy stocks, they buy bonds, they buy other assets, all on behalf of everyone who chipped in. So when you buy one share of a mutual fund, you're not buying one stock. You are buying a tiny little slice of that entire massive portfolio. You're buying a piece of the whole fruit salad. For maybe $100, you can instantly own a tiny piece of Apple, a tiny piece of Microsoft, a tiny piece of Amazon, a tiny piece of Johnson & Johnson, and hundreds of other companies all in one simple purchase. Let's break that analogy down even further, because this is the foundation for everything else. The basket of different investments, the stocks and bonds, is the fruit salad itself. The individual companies like Apple or Ford are the individual fruits. The professional who picks and chooses those investments is the fund manager, our chef. The price you pay for one share of the fund is called the net asset value, or NAV. That's just the price tag on your container of fruit salad. And of course, the grocery store doesn't make that fruit salad for free. They charge you a small fee for the convenience and the chef's expertise. In the world of mutual funds, this is called the expense ratio. It's a tiny percentage you pay each year for the professional management and administration of the fund. This simple idea is one of the most powerful financial inventions in history for three key reasons. First, instant diversification. That's a fancy word for not putting all your eggs in one basket. If you only own one stock and that company goes bankrupt, you lose everything. But when you own a mutual fund, you own tiny pieces of hundreds of companies. If one or two of them do poorly, it's cushioned by the success of the other 98. It's like having one bad grape in your fruit salad. It doesn't ruin the whole thing. This dramatically lowers your risk. Second, professional management. Most of us don't have the time or the expertise to spend 60 hours a week researching companies, reading financial reports, and analyzing market trends. But the fund managers do. That is their entire job. You are essentially hiring a team of experts to manage your money for you, for a very small fee. You're outsourcing the hard work. And third, accessibility and affordability. Before mutual funds, if you wanted to own a diversified portfolio of 100 different stocks, you'd need hundreds of thousands, maybe millions of dollars. But with a mutual fund, you can get that same level of diversification by investing as little as $50 or $100. It opened the door for the average American to participate in the wealth-generating power of the stock market in a way that was never before possible. So, to recap the single most important point of this entire video, a mutual fund is not a stock. It is a basket of stocks, bonds, and other investments, all bundled together into one easy-to-buy package. It is the financial equivalent of buying a pre-made fruit salad instead of driving all over town to buy each fruit individually. Now you understand the what. You get the core concept. But this is just the first piece of the puzzle. It immediately brings up more questions. How do these funds actually make you money? What's the difference between all those crazy names, like a growth fund versus a value fund, or an index fund? And what is that expense ratio we talked about? How much should you be paying and how do you find out? That is exactly where we are going next. We've laid the foundation. Now it's time to start building the skyscraper of your financial knowledge. So let's start with the single most important number you need to know when you're looking at a mutual fund. It's not the 1-year return, it's not the 5-year return, it's not even the fancy name they give it. It's a tiny little percentage called the expense ratio. And this one number, this seemingly insignificant detail, is the silent killer of wealth for millions of Americans. It's the termite in the walls of your financial house, slowly eating away at your returns year after year without you even noticing. Imagine you're buying a car. You see two identical models. They look the same, they drive the same. But the salesman tells you that car A has a mandatory, non-negotiable lifetime maintenance fee of $1,000 a year. Car B has a maintenance fee of only $50 a year. Which car are you going to buy? It's a no-brainer, right? You take car B every single time. The expense ratio is that maintenance fee for your investments. It's a small percentage of your total investment that you pay to the fund company every single year, whether the fund makes money or loses money. This fee covers the salaries of the fund managers, the so-called geniuses picking the stocks, plus administrative costs, marketing, and all the overhead of running a massive financial firm. Now, you might see a fund with an expense ratio of 1% and think, what's the big deal? It's just 1%. But let me show you why that single percentage point is a financial catastrophe over the long term. Let's do some quick math. Say you invest $10,000. And let's assume the market gives you an average return of 8% per year over the next 30 years. Now let's look at two funds. Fund A is an expensive, actively managed fund with a 1% expense ratio. Fund B is a low-cost index fund with a tiny 0.05% expense ratio. In Fund A, your real return each year isn't 8%. It's 8% minus that 1% fee, so you're only getting 7%. After 30 years, your initial $10,000 would grow to about $76,000. Not bad. But what about Fund B? Your real return is 8% minus the minuscule 0.05% fee. So you're getting 7.95%. After 30 years, your $10,000 grows to over $102,000. Let that sink in. By choosing the fund with the lower fee, you ended up with an extra $26,000. That's more than double your initial investment, earned simply by avoiding that seemingly small 1% fee. The fund company didn't work any harder for it. They didn't provide you $26,000 of extra value. They just took it. That is the devastating power of compounding fees. It's the biggest secret Wall Street doesn't want you to fully understand. This brings us to the great debate in the investing world: active versus passive management. Understanding this is key to understanding why some fees are so high and others are so low. Active management is what most people think of when they picture Wall Street. It's a team of highly paid analysts and a star fund manager in a corner office, constantly researching companies, meeting with CEOs, and trying to pick the winners. They are actively buying and selling stocks, trying to outsmart everyone else and beat the market average. Their goal is to get you a 10% return when the market only does 8%. And for this supposed expertise, they charge you that high expense ratio, often 0.8%, 1%, or even higher. It's the price you pay for their genius. Passive management, on the other hand, is the complete opposite. It's most commonly found in what are called index funds. A passive fund manager doesn't try to be a hero. They don't try to pick winners. In fact, they don't pick anything at all. Their philosophy is simple. Why try to find the needle in the haystack when you can just buy the whole haystack? An index is just a list of stocks that represents a slice of the market. The most famous one in the US is the S&P 500. It's simply a list of 500 of the largest, most established companies in America. Think Apple, Microsoft, Amazon, Johnson & Johnson. A S&P 500 index fund is a mutual fund that automatically buys and holds all 500 of those stocks in the exact same proportions as the index itself. There's no genius manager making bets. It's mostly run by computers. The goal isn't to beat the market. The goal is to be the market. And because there's no team of expensive analysts to pay, the expense ratios are incredibly, beautifully low. We're talking 0.1%, 0.04%, sometimes even lower. So, the big question is, are those expensive, actively managed funds worth the price? Do their star managers actually beat the market? The evidence, year after year, study after study, is overwhelmingly no. Data from S&P Global shows that over any 10 to 15-year period, nearly 90% of active fund managers in the US fail to beat their passive index counterparts. Think about that. You have a 9 in 10 chance of paying someone a huge fee for the privilege of underperforming a simple, cheap, automated fund. It's like paying a celebrity chef $1,000 for a hamburger that ends up tasting worse than the one you can get for $5 at the diner down the street. Just doesn't make sense. So when we ask, what makes a good mutual fund? The answer starts to become much clearer. It's not about finding a secret genius stock picker. It's about finding a fund that aligns with your goals and, most importantly, doesn't rob you blind with fees. Let's build a simple checklist. The 4 things you need to look at before you ever put a single dollar into a mutual fund. Number 1, and we've hammered this home for a reason, the expense ratio. This is your first and most important filter. For a passive index fund, you should be looking for a number under 0.2%. Many of the best ones are under 0.1%. For an actively managed fund, if you absolutely feel you must have one, anything over 1% should be a massive red flag. A good target would be under 0.7%. If you can't find the expense ratio in big, bold letters, that's a bad sign. It's usually listed in the fund's summary or prospectus document. Number 2, the fund's objective. What is this fund actually trying to do? You have to match the fund's goal to your goal. Are you a young person investing for retirement 40 years away? You probably want a growth fund, which takes on more risk by investing in companies with high growth potential. Are you already retired and just need to generate some income from your savings? You'd look for an income fund, which might invest in dividend-paying stocks or bonds. Don't buy a fund just because your buddy said it was good. Read the 1-paragraph description of its objective. If its goal doesn't match your goal, it's the wrong fund for you, no matter how good its returns are. Number 3, the holdings. This is where you look under the hood. What is the fund actually invested in? Most fund websites will have a section that lists the top 10 holdings. This gives you a quick snapshot. If you're looking at a US stock fund, you should see names you recognize: Apple, Google, Berkshire Hathaway. If you see a bunch of companies you've never heard of, it might be a fund focused on small companies or international stocks. There's nothing wrong with that as long as that's what you want. The key is to avoid surprises. You don't want to think you're buying a safe, diversified American fund only to find out it's 50% invested in a handful of volatile tech startups. And finally, number 4, past performance. Now, I list this last for a very important reason. Every single piece of financial literature is legally required to state, past performance is not an indicator of future results. And they are right. Choosing a fund just because it was the #1 performer last year is one of the biggest mistakes an investor can make. It's like driving a car by looking only in the rearview mirror. However, looking at long-term performance over 5, 10, or even 15 years can tell you something about the fund's consistency and management. Did it completely fall apart during the last market crash? Or did it hold up reasonably well compared to its peers? Has the fund consistently trailed its benchmark index year after year? If so, it's probably a dud. Use past performance not to predict the future but to diagnose the past. So there you have it. The framework for finding a great mutual fund. It's not about complex charts or financial wizardry. It's about focusing on 4 simple things: low fees, a clear objective that matches your own, holdings that you understand, and a consistent, if not spectacular, track record. You now know more than 90% of the population about how to actually select a good investment. You know the secret of the expense ratio, and you understand the monumental difference between active and passive investing. But now comes the next critical step. You've used the checklist, you've found a fund that looks perfect. It's got a rock-bottom expense ratio, its goals align with yours. Now what? Where do you physically go to buy it? Do you have to call a stockbroker in a fancy suit? Can you just do it from an app on your phone? And what in the world are load fees? These sneaky sales commissions that can cost you 5% of your money before you even start investing. And how do you make absolutely sure you never ever pay one? That bridge from knowing what to buy to actually owning it is exactly where we're going next. Imagine you walk into a nice office. A friendly person in a suit, let's call him Frank, sits you down. He offers you a coffee. He asks about your goals, your family, your dreams of retirement. He seems thoughtful, professional, and trustworthy. And he's not a bad guy. But Frank is a salesperson. His job is to sell financial products, specifically mutual funds. After a great conversation, he says, "I have the perfect fund for you. It's the American Growth Fund of the universe, and it's got a fantastic track record." He shows you a glossy brochure with impressive charts all pointing up. You feel a sense of relief. Finally, someone is helping you figure this out. You decide to invest $10,000. You write the check, shake Frank's hand, and walk out feeling confident. But what you don't see is that the moment your check clears, before your money even has a chance to be invested, a chunk of it vanishes. Poof, gone. If you had invested that $10,000, $575 of it might have been immediately skimmed off the top and put directly into Frank's pocket and his company's coffers. You didn't invest $10,000. You invested $9,425. You started your investment journey by taking a 5.75% loss. Welcome to the world of mutual fund loads. A load is just a fancy, sanitized word for a sales commission. It's the cover charge for getting into the investment club, and it's the single most common trap for new investors. These funds are called load funds, and they come in a few different flavors, usually identified by a letter after the fund's name. This is the alphabet soup of fees. The fund Frank sold you was likely a Class A share. Class A shares are famous for their front-end load. That's the fee you pay up front, the 5.75% we just talked about. It's taken from your investment before it even starts working for you. Why do these exist? Simple. To pay the person who sold it to you. It's their commission. It doesn't make the fund perform better. It doesn't give you any advantage. It just makes you poorer and your salesperson richer. Think about it, to just break even, your investment now has to grow by over 6% just to get back to the $10,000 you started with. You're starting the race 100 yards behind the starting line. Now maybe Frank's colleague, a little more slick, says, "Hey, I get it. You don't want to pay a fee up front. I've got a no-load option for you. This sounds amazing." But what he's offering you is a Class C share. Class C shares typically don't have a front-end load. The trap here is different. It's a slow bleed. Class C shares come with much higher annual expenses, we'll get to those in a minute, and something called a contingent deferred sales charge, or CDSC. That's a mouthful, so let's just call it a getaway fee. If you try to sell your shares within the first year or two, they'll hit you with a penalty, typically 1%. They're betting on you needing that money back or wanting to switch investments. It's like a cell phone plan from 2005. Sure, the phone is free, but try to leave the contract early and see what happens. These fees are designed to lock you in, while they drain your account with higher annual costs. There used to be Class B shares too, which were a monstrous hybrid of back-end loads that eventually converted to Class A shares. They were so notoriously bad for investors that they've almost entirely disappeared, but you might still see them in older accounts. Few do run. So, you have A shares that hit you at the door, C shares that hit you on the way out and every year in between, and B shares that were the worst of both worlds. It feels like a rigged game, doesn't it? But what if I told you there's a fourth option? The one that the Franks of the world rarely mention unless you specifically ask. They're called no-load funds. A no-load fund is exactly what it sounds like. There is no sales commission. Zero. You invest $10,000 and $10,000 goes to work for you from day one. There's no front-end load, no back-end load, no getaway fee. You're starting the race right at the starting line just like everyone else. So the first rule of buying a mutual fund is simple, non-negotiable, and will save you thousands of dollars over your lifetime. Never ever, ever buy a load fund. Only buy no-load funds. Period. But wait, the story doesn't end there. Because the sales commission, as predatory as it is only the most obvious fee. There's a second, far more insidious cost. One that works against you silently every single day, year after year, whether your investment goes up or down. This is the expense ratio. The expense ratio is the annual cost of owning the fund. It pays for the fund manager's salary, the analyst, the marketing, the fancy office building, everything. It's expressed as a percentage of your assets. So a 1% expense ratio means that for every $10,000 you have invested, you are paying them $100 per year every year to manage it. Now 1% doesn't sound like much, does it? It's just a latte argument of the financial world. But that 1% is not a percentage of your profits. It's a percentage of your total money. And its effect over time is absolutely devastating because of the dark side of compound interest. You know how compound interest can make you rich? Well, fees compound too and they make you poor. Let's run the numbers. Let's say you invest that same $10,000 into two different funds. Both funds track the S&P 500 so they have the exact same performance, earning an average of 10% a year for 30 years. Fund A is a typical, actively managed mutual fund. Maybe the one Frank sold you. It has an expense ratio of 1%. Fund B is a low-cost S&P 500 index fund. It has an expense ratio of 0.04%. After 30 years, your investment in Fund B, the low-cost index fund, would have grown to about $168,000. Not bad at all. But what about Fund A? The one with the seemingly tiny 1% fee? After 30 years, your account would be worth only about $132,000. That's a difference of $36,000. That's a new car. A down payment on a house. Years of retirement. That money didn't just vanish. It was systematically transferred from your pocket to the fund company's pocket, one tiny percentage point at a time, over 3 decades. The fund company got rich on your money, not just with your money. That 1% fee didn't just cost you the dollar amount you paid each year. It cost you all the growth that money would have generated for the next 30 years. That is the true brutal cost of high fees. So how do you avoid this? How do you become the detective who spots these traps from a mile away? It's actually incredibly simple. Every single mutual fund in the United States has a unique 5-letter code called a ticker symbol. For example, the ticker for the Vanguard 500 Index Fund is VFIAX. This ticker is the key to everything. Before you ever consider investing a single dollar, you take the name of the fund or its ticker symbol and you type it into Google. You search for fund name expense ratio or ticker symbol fees. The results will pop up instantly from sites like Morningstar, Yahoo Finance, or even the fund company's own website. You are looking for 2 things. First, you look for the word load. Does it say front-end load, 5.75%? If it does, you close the window. It's a non-starter. If it says no load, you proceed to step 2. Second, you look for expense ratio. Is it 1.2%? 0.9%? 0.75%? If so, for most simple funds, that's too high. You can do better. For a basic index fund tracking the S&P 500 or the total stock market, you should be looking for numbers like 0.1% or less. Yes, less than 1/10 of 1%. These funds exist, they are easy to find, and they are available to everyone. By making these two simple checks, is it no load? And is the expense ratio rock bottom low? You will avoid the vast majority of wealth-destroying traps in the mutual fund universe. You will beat 90% of the investors out there who are unknowingly paying these outrageous fees to people like Frank. You now know the vital importance of cost. You know how to identify and dodge the commissions and the slow bleed of high annual fees that cripple most investors. But now a new question emerges. You've filtered out all the bad apples. You're left with a world of low-cost, no-load funds. But there are still thousands of them. How do you choose? What are they actually investing in? What's the real difference between a fund that tracks the S&P 500 and one that tracks the total stock market? And is one secretly much better than the other for building life-changing wealth? Sorting through that final crucial layer of choice is where we're going next. Alright, let's settle the big one. The heavyweight championship for your investment dollars. In one corner you have the legend, the icon, the one you've all heard of, the S&P 500. And in the other corner, the challenger that claims to be even bigger and better, the total stock market. This is more than just picking a fund, it's picking a philosophy. It's the final fork in the road for most American investors. So what exactly is the difference? Think of the S&P 500 as the ultimate all-star team of American business. It's not just the 500 largest companies. That's a common misconception. It's 500 leading companies, chosen by a committee at Standard & Poor's. They look for industry leaders, companies with solid earnings, companies that are stable and significant. This is your starting lineup of titans: Apple, Microsoft, Amazon, Google, Nvidia. These are the blue-chip behemoths, the household names that essentially power the U.S. economy. When you buy an S&P 500 index fund, you are buying a piece of this hand-picked elite team. You're betting on the proven winners. Now, think of the total stock market index. If the S&P 500 is the all-star team, the total stock market is the entire league. It includes all the all-stars. Yes, Apple, Microsoft, and the whole S&P 500 crew are in there, but it doesn't stop. It also includes the second stringers, the promising rookies, the seasoned veterans on smaller teams, and even the players on the bench. We're talking about not just 500 companies, but over 3,000, sometimes closer to 4,000 publicly traded U.S. companies. It owns the big guys, the medium-sized guys, and the small guys. It is, for all practical purposes, the entire investable U.S. stock market in a single basket. You're not just betting on the winners, you're betting on the whole game. So the fundamental difference boils down to this. A total stock market fund holds everything the S&P 500 fund holds, plus thousands of smaller companies. These are what we call mid-cap and small-cap stocks. And this is where the debate gets heated. The argument for the total stock market is all about diversification and growth. Proponents will tell you, why would you only bet on the current giants? The next Amazon, the next Tesla, is probably a small, innovative company right now. By owning the total market, you guarantee that you will own that company as it grows into a titan. You capture the explosive growth of smaller, more nimble companies before they become household names. You own the entire haystack, so you're guaranteed to own the needle. It's the ultimate bet on American innovation, from the garage startup that just went public to the global megacorporation. The argument for the S&P 500, however, is a powerful counterpunch. It comes from a place of quality control. The legendary founder of Vanguard, Jack Bogle, was famously a fan of the S&P 500. His logic was simple but profound. The S&P 500 is a collection of America's best. These are profitable, established blue-chip companies. The thousands of smaller companies in the total market? Well, many of them are unproven. Many will fail. Many are not yet consistently profitable. So, Bogle asked, why would you want to intentionally dilute your investment in the proven winners by adding thousands of less proven, speculative, or outright struggling companies to the mix? He called it a winner's portfolio. You're letting the market do the hard work of filtering out the weak, and you're just investing in the champions that remain. Okay, that's the theory, the philosophy. But what about the money? What happens when we put them head-to-head in the real world? Which one actually performs better? This is the part that shocks almost everyone. When you lay the performance charts of an S&P 500 fund and a total stock market fund on top of each other, they are nearly identical. It's almost impossible to tell them apart. Year after year, decade after decade, they move in near-perfect lockstep. Sometimes the total market is up by a fraction of a percent more. Sometimes the S&P 500 edges it out. But over the long run, the difference in your final account balance is likely to be astonishingly small. How can this be? How can a fund with 500 stocks perform almost exactly like a fund with over 3,500 stocks? The answer is the most important concept in index investing: market cap weighting. Remember how we said index funds are weighted so the bigger the company, the bigger piece of the fund it represents? Well, the companies in the S&P 500 are so colossally massive that they completely dominate the entire market. The S&P 500 alone represents about 80 to 85% of the total value of the US stock market. Let that sink in. Those 500 companies make up the vast, overwhelming majority of the market's entire worth. So, when you buy a total stock market fund, what are you really getting? You're getting a fund that is about 80 to 85% identical to an S&P 500 fund. The other 15 to 20% of your money is then sprinkled across thousands of those smaller mid-cap and small-cap companies. Think of it like a recipe for a chili. The S&P 500 is a big, hearty pot of chili made with beef, beans, and tomatoes. The total stock market is the exact same pot of chili, but you've sprinkled in a teaspoon of a special spice blend made from 100 different exotic peppers. That spice blend might add a tiny bit of extra kick, a little bit of different flavor, but at the end of the day, you're still eating the same pot of chili. The beef, beans, and tomatoes are what overwhelmingly determine the taste. Apple and Microsoft are the beef and beans. The thousands of small companies are the spice blend. Their individual movements just don't have enough weight to meaningfully change the direction of the overall fund. The tail doesn't wag the dog. So we arrive at the million-dollar question. Which one should you choose? And the beautiful, liberating answer is, it doesn't really matter that much. Honestly, the financial world loves to create these epic debates, but this is one where the difference is more academic than practical. Choosing between an S&P 500 fund and a total stock market fund is like agonizing over whether to paint a room off-white or eggshell. For all practical purposes, it's the same color. If you are a diversification purist, if you believe in owning every single piece of the American economy and guaranteeing you'll capture the next big winner, then the total stock market fund is your philosophical match. You want to own the whole league. If you're a boglehead purist, if you believe in owning only the proven, profitable, blue-chip winners and not diluting your returns with speculative smaller companies, then the S&P 500 is your champion. You want to own the all-star team. But the key takeaway is this: the difference in outcome between these two choices is minuscule compared to the difference between picking one of them and doing nothing at all. The single greatest financial mistake you can make is not choosing the wrong fund, but suffering from analysis paralysis, choosing no fund, and leaving your money sitting in a savings account where it gets eaten alive by inflation. Pick the one whose story makes more sense to you. Flip a coin. It's fine. The important thing is to make a choice and get your money working for you in the incredible engine of American enterprise. You've successfully navigated from the universe of thousands of funds down to two of the best, most effective wealth-building tools ever created. You've basically won the game already. But wait, both of these funds, the S&P 500 and the total stock market, have a shared and potentially massive blind spot. They are 100% focused on a single country, the United States. America has been the undisputed champion of the world economy for a very long time. But is that guaranteed to continue forever? What about the explosive growth happening in emerging markets? What about the established titans of industry in Europe and Japan? By investing only in US stocks, are you making a concentrated bet on one single country and ignoring 50% of the world's investment opportunities? Is a total US stock market fund truly total, or is it dangerously incomplete? That question, whether to go global or stay home, is the next great debate we need to settle. And it has far bigger consequences for your money than S&P versus total market ever will. So let's talk about one of the biggest and most emotionally charged debates in personal finance: the United States versus the world. At first glance, the argument for sticking to American companies seems almost unassailable. Why would you ever bet against the USA? We have the world's reserve currency. We have the deepest, most liquid financial markets on the planet. We're home to Apple, Microsoft, Amazon, Google, the titans of modern industry that have fundamentally changed the way human beings live. For the last decade and a half, betting on America has been the winning move, and it hasn't even been close. If you had put your money in an S&P 500 fund, you would have absolutely crushed someone who invested in a broad international fund. The data is undeniable. So the question is, why on earth would you dilute your winners? Why would you take your money away from the strongest horse in the race and give it to the ones lagging behind? This is a powerful, compelling argument. It's rooted in patriotism, in recent experience, And in the simple logic of sticking with what works, feels safe, feels familiar, we know these companies. We use their products every single day. Investing in foreign companies can feel like you're exploring uncharted territory, dealing with currencies you don't understand and political systems you can't predict. This powerful pull towards investing in your own country has a name. It's called home country bias. And Americans have one of the strongest cases of it in the world. But here's the uncomfortable truth we have to confront. Is this confidence, this USA all-the-way strategy, based on sound financial principles? Or is it based on a dangerous psychological trap, known as recency bias? Recency bias is the belief that what has happened recently will continue to happen forever. It's looking at the last 10 years of US stock market dominance and assuming that's just the natural order of things. But if we zoom out, if we look at the entire history of modern financial markets, a very, very different picture emerges. And it's a picture that should make anyone with a 100% US portfolio feel a little nervous. Let's hop in a time machine. Go back to the late 1980s. The undisputed economic heavyweight champion of the world wasn't the United States. It was Japan. The Japanese stock market, the Nikkei, was on an unbelievable tear. Japanese companies were buying up iconic American assets like Rockefeller Center and Pebble Beach. The world's 10 largest companies by market capitalization were almost all Japanese. Financial experts were writing books about how the Japanese management style was superior and how America was in a state of irreversible decline. If you were an investor in Tokyo in 1989, you would have felt insane putting your money anywhere else. And then the bubble burst. The Japanese stock market crashed, and more than 3 decades later, it still hasn't returned to its 1989 peak. Imagine investing for your retirement and making zero progress for 30 years. That is the devastating risk of putting all of your faith in a single country's market, no matter how invincible it seems at the time. Okay, you might say, that was Japan. A weird anomaly. That could never happen here. Let's try another decade. The 2000s. From the year 2000 to the end of 2009. If you had invested $1 in the S&P 500 on January 1, 2000, by the end of that decade, after the dot-com bust and the 2008 financial crisis, your dollar would have been worth about 90 cents. You would have actually lost money over 10 years. It's known as the lost decade for US stocks. But you know what did incredibly well during that period? International stocks, especially emerging markets. Countries like Brazil, Russia, India, and China were booming. An investment in an emerging markets fund during that lost decade for the US would have nearly tripled your money. So you see the pattern? Leadership changes. The 1980s belonged to Japan. The 1990s, the dot-com era, belonged to the US. The 2000s belonged to the rest of the world. And the 2010s up to today have belonged to the US again. It's a tug of war. No single winner dominates forever. To bet everything on the US continuing its winning streak is to bet that this time, for the first time in history, it's different. And this time is different are 4 of the most expensive words in investing. The fundamental reason for investing internationally isn't about predicting who will win the next decade. It's the exact opposite. It's about admitting that you can't predict the winner. It's about humility. It's about building a portfolio that doesn't require a crystal ball to succeed. Think of it like a plane. A US-only portfolio is a plane with one massive, powerful engine. And that engine has been running beautifully for years. But if that one engine sputters due to a recession, a political crisis, a technological shift we can't foresee, the whole plane goes down. A globally diversified portfolio is a plane with 2 engines. Maybe the US engine is bigger and stronger right now, but you've also got that international engine. If one falters, the other can keep you airborne, allowing you to reach your destination safely. It's not about maximizing your speed in the best of times. It's about surviving the worst of times. Now, a common argument you'll hear today is that you don't need to buy international funds because big US companies like Coca-Cola or Apple are already global. They sell their products all over the world, so by owning them, you're already diversified. This sounds smart, but it's a dangerously flawed piece of logic. Yes, Coca-Cola sells soda in over 200 countries. But where is Coca-Cola's stock listed? On the New York Stock Exchange. What currency does it operate in? The US dollar. Who sets the interest rate policies that most affect its borrowing costs? The US Federal Reserve. The stock is still fundamentally tied to the health of the US economy and US financial markets. Owning a German car company like Volkswagen, a Swiss food giant like Nestle, or a Taiwanese semiconductor manufacturer like TSMC gives you exposure to entirely different economic cycles, different currency movements, and different political landscapes. That is true diversification. And here's the final crucial point. The US economy, while massive, is a shrinking piece of the global pie. In 1960, the US accounted for about 40% of the world's economic output. Today, it's closer to 25%. And that number is projected to continue falling as emerging economies grow. By investing only in the US, you are making a conscious decision to ignore 75% of the world's economy. You're ignoring thousands of innovative, profitable companies simply because they don't happen to be headquartered within our borders. Does that sound like a prudent long-term strategy? So, that total stock market fund we talked about? It's really the total US stock market fund. And it is, by any logical definition, dangerously incomplete. It's a massive, concentrated bet on one single country. Adding international funds to your portfolio isn't un-American. It's not a bet against our country. It is one of the smartest, most rational decisions an investor can make to reduce risk and improve their long-term returns. It's about building an all-weather portfolio that can thrive no matter which country or region is leading the charge. It's about acknowledging that great ideas and economic growth happen everywhere. We've now settled the great debate. The answer isn't US or the world. The answer is US and the world. But this victory creates a brand new, and arguably even more difficult problem. Once you agree that you need both, the critical question becomes, how much of each? What's the right mix? Should it be 80% US and 20% international? 60-40-ish? Or maybe a true global split based on market weight, which would be closer to 50-50? Finding that magic number, that perfect allocation between your home team and the rest of the world, is the key to unlocking the true power of diversification. And that is exactly where we're going next. So, what is that magic number? What's the perfect split between US stocks and international stocks? This is one of the most hotly debated topics in personal finance, and the answer isn't a simple number, because it's not just about math. It's about psychology. Most Americans suffer from something called home country bias. It's natural. We live here, we work for American companies, we buy American products. The S&P 500, the Dow Jones, these are household names. We hear about them on the news every single night. Companies like Apple, Amazon, and Google are global titans, but they feel like our companies. So, when it comes to investing, our gut tells us to stick with what we know. Why bet on a company in Germany or Japan when you can bet on the home team? Especially when the home team has been winning so consistently for the last decade. This feeling is powerful. It's so powerful that the average American investor has about 79% of their stock portfolio in US companies. That's a massive bet on a single country, even if it is the world's largest economy. To understand why this can be so dangerous, we need to take a trip back in time. Not to the ancient past, but to a period many of us lived through and have tried our best to forget, the 2000s. Let's imagine it's January 1st, 2000. The Y2K bug was a bust, the internet is booming, and the future looks bright. You take $10,000 and you invest it all in a mutual fund that tracks the S&P 500. You're all in on America. You feel like a genius. Then the dot-com bubble bursts. The market crashes. A few years later, just as things are starting to feel a little better, the 2008 financial crisis hits, and the market collapses again. So you wait. You hold on, you don't panic sell. You do everything you're supposed to do. Finally, the calendar flips to December 31st, 2009. A full 10 years have passed. You check your account balance. Your initial $10,000 investment in the great American stock market is now worth about $9,100. You lost money. Over an entire decade. After accounting for inflation, you lost significantly more. This wasn't a blip. It was a 10-year-long winter for US investors. It's now known as the lost decade. If you had 100% of your money in US stocks, you made zero progress towards your retirement for 10 straight years. It was brutal. But what if you had done something different? What if, back in 2000, you decided to be a global investor? Instead of putting all your eggs in the American basket, you put 60% in the US and 40% in an international stock mutual fund. While the US market was struggling, something incredible was happening elsewhere. The world was changing. Countries like China, India, and Brazil were experiencing explosive economic growth. The term BRIC was on every financial news channel. These emerging markets were on fire. Developed markets in Europe were also holding their own. So, while your US stocks were going nowhere, your international fund was quietly growing. It wasn't a smooth ride. The 2008 crisis was a global one, but the growth from the rest of the world was enough to offset the stagnation in the United States. At the end of that same lost decade, your globally diversified portfolio wouldn't have lost money. It would have grown. You would have been ahead of the game simply because you didn't bet on just one horse. Now let's flip the script. As soon as the lost decade ended, the tables turned dramatically. The 2010s became the decade of American dominance. US tech companies, the Apples, the Amazons, the Facebooks took over the world. The S&P 500 went on one of the most incredible bull runs in history. During this time, international markets were the ones that stagnated. They dealt with sovereign debt crises in Europe and slowing growth in China. An investor who was 100% in the US during the 2010s felt like a king. They crushed the returns of the global investor. They looked at their portfolio and thought, "See? I told you. America is the only place to invest. Why would I ever own anything else?" And that right there is the trap. We are all prisoners of recent history. The 2010s are much clearer in our memory than the 2000s. So we project the recent past into the infinite future. We assume that because the US has done well for the last 10 or 12 years, it will do well for the next 10 or 20. But history shows us in painful detail that leadership rotates. No single country stays on top forever. The 1980s, for example, belonged to Japan. The Japanese stock market was so hot, people thought it would never cool down. Then it crashed and has been largely stagnant for 30 years. The goal of diversifying internationally is not to pick the next winner. It's not about trying to guess if the 2020s will belong to Europe or Asia or the US. The goal is to accept that you cannot know. It is an act of humility. By owning the whole world, you guarantee that you will capture the growth wherever it happens. You give up the chance to have the absolute best performing portfolio in any given year. But in exchange, you protect yourself from the catastrophic risk of having the absolute worst performing portfolio for an entire decade. It's about building a resilient all-weather machine, not a high-strung race car that only works on a perfect track. So what is the practical advice? What's the number? Most experts, including giants like Vanguard and Fidelity, have studied this extensively. Their research suggests that for a US-based investor, allocating somewhere between 20% and 40% of your stock portfolio to international funds provides the best diversification benefit. It gives you meaningful exposure to the rest of the world's growth without taking on too much currency risk or volatility from less stable markets. A 40% international allocation is a very common and sensible recommendation. It's a significant enough chunk that it will actually help your portfolio when the US market is struggling. Another simple, logical approach is to just own the world in its natural proportions. This is called a global market cap weight. Right now, the US stock market makes up about 60% of the total value of the world's stock markets. So, a simple strategy is to mirror that. 60% in a US mutual fund and 40% in an international mutual fund. This is the ultimate neutral position. You're not making a bet that one country will do better than another. You're simply owning the entire global pie, sliced up by its current size. As those sizes change, your portfolio can adapt. Whether you choose a 60-40, a 70-30, or an 80-20 split between US and international is less important than the act of choosing to diversify in the first place. Moving from 100% US to even 80% US is a huge step toward building a more robust, more resilient financial future. It's admitting that while America is an amazing economic engine, it's not the only one. But we've been talking exclusively about stocks. US stocks, international stocks. It's all about capturing growth. But what about managing risk? What happens when the entire global stock market takes a nosedive, like it did in 2008 or briefly in 2020? Growth is only one half of the investing equation. The other half is stability. It's about having a part of your portfolio that acts as a shock absorber, that zigs when everything else zags. This is where we move beyond just picking stocks and start talking about true portfolio construction. We need to introduce a completely different asset class, one that's designed not for thrilling growth, but for boring, predictable, sleep-at-night safety. We need to talk about the anchor of your financial ship. We need to talk about bonds. Bonds are the unsung heroes of the investment world. While stocks are throwing the wild party, bonds are the designated driver, making sure everyone gets home safe. At its core, a bond is just a loan. That's it. You, the investor, are the lender. Some big entity, a corporation, a city, or even the entire United States government is the borrower. Imagine your city wants to build a brand new, state-of-the-art high school. That costs hundreds of millions of dollars. The city doesn't have that kind of cash just sitting around, so it decides to borrow it. It issues bonds. You buy one of those bonds for, say, $1,000. You have just loaned the city $1,000. In return for your loan, the city promises two things. First, they promise to pay you regular interest payments, often twice a year. This is called the coupon. It's your reward for letting them use your money. Second, they promise that at a specific date in the future, called the maturity date, they will pay you your original $1,000 back in full. You get a steady stream of income, and then you get your principal back at the end. It's predictable, it's stable, and it's how almost every major project in this country gets funded, from bridges and airports to corporate expansions and new technologies. Now, who you lend your money to matters a lot. Loaning money to a brand new, speculative tech startup is a lot riskier than loaning money to, say, Apple or Johnson & Johnson. The startup might go bankrupt and you could lose everything. Apple? Much less likely. This difference in risk is reflected in the interest rate they offer you. The riskier the borrower, the higher the interest rate they have to pay to convince you to lend them money. But there is one borrower that is considered the safest on planet Earth. The gold standard. The borrower that every other borrower is measured against. And that is the United States government. When you buy a U.S. Treasury bond, you are loaning money directly to Uncle Sam. The U.S. government has the power to tax its citizens, and if it absolutely had to, print more money. Because of this, the risk of the U.S. government defaulting on its debt is considered to be virtually zero. They have never ever missed a payment. This is why U.S. Treasury bonds are often called a risk-free asset. They are the financial bedrock of the entire global economy. So, if bonds are so safe and simple, why not just buy a bunch of them? Well, just like with stocks, buying individual bonds can be a pain. You have to research the financial health of the company or municipality. You have to worry about maturity dates. If you buy a 10-year bond, you have to wait 10 years to get your principal back unless you sell it to someone else. And what if you only have a few $1,000s to invest? Diversifying across dozens of different bonds is nearly impossible. And you already know the solution, don't you? It's the same elegant solution we found for stocks. Instead of buying one bond, we buy a tiny piece of a giant basket filled with hundreds or even thousands of them. We buy a bond mutual fund. A bond fund does all the work for you. A team of professionals researches and selects a diversified portfolio of bonds. They manage all the maturity dates, reinvesting the money from maturing bonds into new ones so you don't have to. You get instant diversification and professional management, all in one easy purchase. And just like stock funds, bond funds come in all different flavors. There are U.S. Treasury bond funds that hold nothing but those ultra-safe government IOUs. There are corporate bond funds that lend money to America's biggest companies. There are high-yield bond funds, which is a polite way of saying they lend to riskier companies in exchange for much higher interest payments. There are even municipal bond funds that lend to states and cities, and the interest they pay is often exempt from federal income tax, which can be a huge benefit. By choosing a bond fund, you can precisely control the level of risk and income you want from the safe portion of your portfolio. But there's one critical concept about bonds that we absolutely have to understand. It's the single most confusing thing for new investors, but I'm going to make it simple. It's the relationship between bond prices and interest rates. And here it is. When interest rates in the economy go up, the price of existing bonds goes down. And when interest rates go down, the price of existing bonds goes up. They have an inverse seesaw relationship. Why? Let's use an analogy. Imagine you buy a brand new bond today for $1,000. It's a 10-year bond and it pays you 4% interest per year. You're happy. You're getting $40 a year for the next 10 years. But then, a month later, the Federal Reserve raises interest rates to cool down the economy. Now, brand new 10-year bonds being issued are paying 5% interest. Think about it. You're stuck with your old 4% bond. If you wanted to sell it to someone, why would they pay you the full $1,000 for it? They could just go out and buy a brand new bond for $1,000 and get 5% interest. They'd be crazy to buy your old, lower-paying bond for the same price. The only way you could convince someone to buy your 4% bond is by offering them a discount. You'd have to sell it for, say, $950. The price of your bond had to go down to compete with the new, more attractive bonds on the market. That's interest rate risk. It's the risk that rates will rise, causing the market value of your existing, lower-rate bonds to fall. The reverse is also true. If you bought that 4% bond and rates then fell to 3%, your bond would suddenly look amazing. Everyone would want it. You could sell it for more than $1,000 at a premium, because it pays a higher interest rate than the new bonds being issued. This is why a bond fund's value, its share price or NAV, can still go up and down every day, even though it's considered safe. It's not fluctuating because companies might go bankrupt, like with stocks. It's fluctuating primarily because of changes in the prevailing interest rates in the economy. So let's bring this full circle. Why do we own these things? What is their job in our portfolio? Bonds and bond funds play two crucial roles. First, they provide income. Those regular interest payments are a reliable stream of cash flow, which can be reinvested or used to live on in retirement. Second, and most importantly, they provide stability. They are the shock absorber. Think back to a major market crash. What's usually happening? The economy is in trouble, investors are panicking, and they're selling their stocks. Where do they put that money? They flee to safety. And what is the ultimate safe haven in the financial world? U.S. Treasury bonds. So as money pours out of the stock market and into the bond market, the price of those bonds gets bid up. This is the beautiful diversification we've been talking about. In many financial crises, as your stock funds are going down, your high-quality bond funds are often stable, or even going up in value. They act as a counterbalance, the anchor. They reduce the overall volatility of your portfolio and prevent you from suffering the full, gut-wrenching force of a stock market crash. They are what allows you to sleep at night, knowing that not all of your money is on that wild stock market roller coaster. So now the picture is becoming clear. We have two powerful fundamental building blocks. On one side, we have stock mutual funds, our engine for long-term growth, designed to harness the power of American and global capitalism. On the other, we have bond mutual funds, our anchor of stability, designed to provide income and protect us when storms hit. They are the yin and the yang of a successful investment strategy. The final and most important piece of the puzzle is figuring out how to combine them. How much of your money should go into the engine, and how much should be tied to the anchor? This isn't just a financial question. It's a deeply personal one. The answer depends on your age, your goals, and your personal tolerance for risk. Getting this mix right, a concept known as asset allocation, is the single most important investment decision you will ever make. It has a greater impact on your long-term results than any hot stock tip or brilliant market prediction. And that is exactly what we are going to break down next. So, think of your investment portfolio like a championship football team. You can have the best, most talented quarterback in the league, a superstar stock that everyone is talking about. But if you have no offensive line to protect him, no running backs to support him, and no defense to stop the other team, you're going to lose badly. That superstar quarterback is going to spend the whole game on his back, and your team is going nowhere. Asset allocation is your team strategy. It's the game plan. It's deciding how many players you put on offense, how many on defense, and how many on special teams. It's the structure that allows your star players to actually shine and, most importantly, wins you the championship over the long season. So what is it, exactly? In the simplest terms, asset allocation is how you divide your investment dollars among different categories or classes of assets. While there are many exotic options out there, for 99% of American investors, it boils down to a mix of three main players: stocks, bonds, and cash. Let's meet the team. First up, you have stocks, also known as equities. These are your offensive superstars, your quarterbacks, your wide receivers. They are built for growth and scoring points. When you buy a stock or a stock mutual fund, you are buying a tiny piece of ownership in actual companies. Think Apple, Amazon, Johnson & Johnson. As these companies grow, innovate, and make profits, the value of your ownership stake, your stock, hopefully goes up. Over the long haul, stocks have historically provided the highest returns of any major asset class. They are the engine of wealth creation. But like a star quarterback, they can be volatile. They can have amazing games and terrible games. They carry the highest potential reward, but also the highest risk of short-term losses. Next, you have bonds, also known as fixed income. This is your defense, your big, reliable offensive line. Their job isn't to score thrilling, 80-yard touchdowns. Their job is to protect your portfolio, to provide stability and consistency. When you buy a bond, you're not buying ownership. You're essentially lending money to a government or a corporation. In return, they promise to pay you back the full amount, called the principal, on a specific date, and along the way they pay you regular interest payments. It's a predictable stream of income. Bonds are generally much less volatile than stocks. When the stock market is having a panic attack, bonds are often the calm, steady hand that keeps your overall portfolio from collapsing. They offer lower potential returns than stocks, but also significantly lower risk. They grind out the tough yards and prevent catastrophic losses. Finally, you have cash and cash equivalents. Think of this as your players on the sideline ready to jump in. This includes money in a high-yield savings account, money market funds, or very short-term government debt. Its primary job is safety and liquidity. Cash won't grow much. In fact, after inflation, it often loses a little purchasing power each year. So why hold it? 2 reasons. First, for emergencies. It's your oh crap fund, easily accessible when you need it. Second, for opportunity. When the market takes a dive and everything is on sale, having cash on the sidelines allows you to be a strategic buyer, picking up quality investments at a discount. The magic happens when you put these 3 players together on the same team in the right proportions. This is the core of asset allocation. Understanding that stocks, bonds, and cash all behave differently under different economic conditions. They don't always move in the same direction. This is a concept called correlation, and it's your secret weapon. In a great year for the economy, your stocks might be up 25% soaring high. Your bonds might only be up 3% just chugging along. But in a terrible year, when fear grips the market and your stocks are down 20%, your high-quality bonds might actually go up in value as investors flee to safety. In that scenario, your overall portfolio might only be down 5 or 6%, instead of a gut-wrenching 20%. That is the power of your portfolio's defense. Smooths out the ride. It turns a terrifying roller coaster into a series of rolling hills, making it far more likely that you'll stick with your investment plan and not panic sell at the absolute worst possible moment. So, the billion-dollar question is, what is the right mix for you? There is no single answer because the right asset allocation is deeply personal. It depends on 3 critical factors: your time horizon, your risk tolerance, and your financial goals. First and most important is your time horizon. This is simply how long you have until you need the money. Are you a 25-year-old saving for retirement in 40 years? Or are you a 62-year-old looking to retire in 3 years? The answer dramatically changes your game plan. The 25-year-old has the incredible gift of time. If the market crashes tomorrow, it's upsetting, but in the grand scheme of a 40-year career, it's just a blip. They have decades to recover and for their investments to compound. Therefore, they can afford to be aggressive. Their allocation might be 90% in stocks and 10% in bonds. They want maximum growth and they can stomach the volatility to get it. The 62-year-old is in a completely different situation. A massive market crash right before they retire could be devastating. They don't have decades to make up for those losses. Their priority has to shift from aggressive growth to capital preservation. They need to protect what they've spent a lifetime building. Their allocation might be the complete opposite, maybe 40% in stocks and 60% in bonds and cash. They are playing defense to protect their lead in the final minutes of the game. The second factor is your risk tolerance. This isn't about time, it's about your stomach. It's the psychological side of investing. How do you personally react to market volatility? If you logged into your account and saw that your life savings had dropped by 30% in a month, a very real possibility in a severe downturn, what would you do? Would you feel sick, panic, and sell everything to stop the bleeding? Or would you grit your teeth, remind yourself of your long-term plan, and maybe even see it as a chance to buy more? You have to be brutally honest with yourself here. A theoretically perfect asset allocation is useless if it causes you to lay awake at night and make emotional, destructive decisions. It's better to have a slightly less aggressive portfolio that you can actually stick with than a hyper-aggressive one that you abandon at the first sign of trouble. This is often called the sleep at night test. And the third factor is your financial goals. Why are you investing in the first place? Saving for retirement in 30 years is a long-term goal that calls for a growth-oriented, stock-heavy portfolio. But saving for a down payment on a house you want to buy in 3 years is a short-term goal. You can't afford to risk that money in the stock market. What if the market crashes 2 months before you're supposed to close on your dream home? That down payment money should be in a very conservative allocation, perhaps entirely in cash and short-term bonds. So how do you put this all together? For a simple starting point, many people use a rule of thumb. One of the most famous is the 110 minus your age rule. You take the number 110, subtract your age, and that's the percentage of your portfolio that should be in stocks. So if you're 40 years old, 110 minus 40 is 70. That suggests a portfolio of 70% stocks and 30% bonds. If you're 60, it suggests 50% stocks. It's not a perfect, one-size-fits-all law, but it's a fantastic starting point that automatically accounts for your changing time horizon. Now, this might sound complicated to manage. Constantly rebalancing your stocks and bonds can be. And that's where a specific type of mutual fund comes in to save the day for millions of Americans. The Target Date Fund. We've mentioned them before, but now you can see why they are so powerful. A Target Date 2050 fund, for example, is designed for someone planning to retire around the year 2050. When you're young, the fund automatically holds an aggressive allocation, maybe 90% stocks. But as you get closer and closer to 2050, the fund manager automatically and gradually shifts the mix, selling stocks and buying more bonds. It becomes more conservative over time, all without you having to do a thing. It puts your asset allocation strategy on autopilot. Ultimately, asset allocation is about controlling what you can control. You cannot control whether the stock market goes up or down next year. You cannot predict which company will be the next Apple. But you can control your mix of offense and defense. You can build a portfolio structure that is resilient, that aligns with your timeline and your temperament, and that gives you the highest probability of reaching your financial goals. We've drawn up the blueprint. We understand the fundamental strategy. Now it's time to grab the tools and start building. In the next part, we're going to dive into the specific types of stock and bond mutual funds you can use to bring your asset allocation plan to life. Think of the world of mutual funds as a massive, sprawling hardware store. In the last part, we drafted the blueprint for our financial house, our asset allocation. We know how many rooms we want, how big the foundation needs to be. Now we're walking into that hardware store, and it's time to pick out the actual lumber, the pipes, and the wiring. It can feel overwhelming. There are aisles and aisles of options. But just like in a real store, everything is organized into sections. And once you understand the layout, finding what you need becomes simple. Let's start in the most popular section of the store, the stock funds. This is where you buy ownership in businesses. But not all businesses are the same. A tiny tech startup is fundamentally different from a global beverage company that's been around for a century. So we categorize them, primarily using what's called a style box. It's a simple grid that classifies funds based on two things: the size of the companies they invest in, and the style of their investment strategy. First, let's talk about size, or what the financial world calls market capitalization. This is just a fancy term for the total value of a company's stock. We break it down into three main categories: large cap, mid cap, and small cap. Large cap stock funds are your household names. These funds invest in the giants of the American and global economy, the Apples, the Microsofts, the Johnson & Johnsons. These are massive, stable, well-established companies. Think of them as the big, sturdy oak trees in the forest. They've weathered storms before, they have deep roots, and while they might not grow as explosively fast as a sapling, they provide reliable, steady growth and stability to your portfolio. A large cap index fund, like one that tracks the S&P 500, is often the cornerstone of an American investor's portfolio for this very reason. It's a single purchase that gives you a piece of 500 of the biggest players in the game. Next, we have mid-cap funds. These are the companies that have successfully graduated from their startup phase, but aren't yet household names across the entire country. They're in a growth sweet spot. They're more established and less risky than small companies, but they still have much more room to grow than the large-cap giants. Think of a successful regional restaurant chain that's just starting to expand nationwide. It has a proven business model, but its biggest growth story could still be ahead. Mid-cap funds offer a compelling blend of the growth potential of smaller companies and the stability of larger ones. Finally, there are the small-cap funds. These funds invest in the up-and-comers, the innovators, the potential disruptors. These are the saplings in the forest, growing at a rapid pace, reaching for the sunlight. Now, with this high growth potential comes higher risk. Some of these companies will become the next titans of industry. Many others will falter or fail. Investing in a small cap fund diversifies you across hundreds of these companies, spreading out that risk while giving you exposure to that explosive growth potential. They can add a powerful engine to your portfolio, but they also create a bumpier ride. So that's size. The other side of the style box is investment style, growth, value, and blend. Growth funds, as the name implies, focus on companies that are expected to grow their earnings at a faster rate than the overall market. These are often tech companies, biotech firms, or any business in an innovative, rapidly expanding industry. They typically reinvest all their profits back into the company to fuel that expansion, so they rarely pay out dividends to shareholders. Think of a growth company as a young, ambitious professional. They're not taking cushy vacations. They're reinvesting their time and money into their career to climb the ladder as fast as possible. On the opposite end of the spectrum, you have value funds. These funds are like bargain hunters. They seek out solid, established companies that the market might be overlooking or unfairly punishing. Maybe the company had a bad quarter or is in an unpopular industry. A value investor believes the stock is trading for less than its true, intrinsic worth. These companies are often more mature, generate consistent cash flow, and are more likely to pay dividends. Think of finding a classic, well-made piece of solid wood furniture at a garage sale for a fraction of its real value. It's not flashy, but it's high quality and built to last. And right in the middle, you have blend funds. These funds don't lean too heavily in either direction. They hold a mix of both growth and value stocks, aiming to capture the best of both worlds and provide a more balanced approach. So when you see a fund described as a large-cap value fund, you now know exactly what that means. It invests in big, established companies that it believes are currently undervalued by the market. A small-cap growth fund? It's investing in small, innovative companies poised for explosive growth. Understanding this style box allows you to pick the exact tools you need to build out the stock portion of your portfolio, according to your blueprint. But what about the rest of the world? So far, we've mostly been talking about US companies. That's where international funds come in. These funds invest in companies outside of the United States, giving you global diversification. This is crucial. Sometimes the US market is booming while international markets are struggling. And sometimes the reverse is true. Owning international funds is like having a second engine for your plane. If one sputters, the other can keep you flying. These are often broken down into developed markets like Europe and Japan, and emerging markets like Brazil or India, which offer higher growth potential but also higher risk. Now let's leave the stock aisle and walk over to the other side of the store, the bond funds. If stocks are the engine of your portfolio, designed for growth, bonds are the brakes and the suspension system. They are designed for stability, income, and to smooth out the ride. When you buy a bond, you're not buying ownership, you're lending money. In return, the borrower pays you interest. Bond funds simply pool together thousands of these loans. Just like with stocks, there are different types of bond funds categorized mainly by who is borrowing the money and for how long. First up are the safest of the safe, U.S. Treasury funds. When you buy into one of these, you are lending money to the United States government. They are considered to have virtually zero risk of default because they are backed by the full faith and credit of the U.S. government, which can, if needed, print more money to pay its debts. Because they are so safe, they offer lower interest payments or yields than other types of bonds. Next are municipal bond funds or muni funds. These funds lend money to state and local governments to fund projects like building schools, roads, and bridges. Their superpower is their tax advantage. The interest you earn from muni bonds is typically exempt from federal income tax. And if you live in the state that issued the bond, it's often exempt from state and local taxes too. This makes them especially attractive for investors in high tax brackets. Then we have corporate bond funds. Here, you're lending money to companies from blue-chip giants to smaller businesses. Because there's a higher risk that a company could go bankrupt compared to the US government, these bonds have to offer a higher interest rate to attract lenders. Corporate bond funds are further split into investment grade, which are loans to financially stable, reliable companies, and high-yield bonds, also known as junk bonds. These are loans to less stable companies, carrying a much higher risk of default, and therefore, they must pay a much higher rate of interest to compensate for that risk. The final major category for bonds is duration, how long the loans are for. You'll see short-term, intermediate-term, and long-term bond funds. The key thing to understand here is interest rate risk. If interest rates in the economy go up, the older bonds with lower rates become less valuable. Long-term bonds are the most sensitive to these changes, making them the riskiest. Short-term bonds are the least sensitive, making them the most stable. Intermediate-term funds once again offer a balance between the two. So we have the lumber, our stock funds categorized by size and style. We have the plumbing and wiring, our bond funds categorized by issuer and duration. We understand the individual pieces. We can see how a young investor might lean heavily into small-cap growth and international funds, while someone nearing retirement might build their house with the sturdy foundation of large-cap value and U.S. Treasury bond funds. The blueprint is in hand. The materials are laid out before us. The only thing left to do is to put it all together. It's time to take this knowledge, walk up to the checkout counter, and build a portfolio that will stand the test of time. So let's walk through those doors and turn this plan into reality step by step. The first thing you need is a place to buy your funds. This is called a brokerage account. Think of it as the supermarket for your investments. For decades, buying into the market meant dealing with a stuffy, expensive broker in a fancy suit. Those days are over. Today, the best options are low-cost online brokerage firms. Companies like Vanguard, Fidelity, and Charles Schwab are the big three for a reason. They are built for the individual investor. They offer a massive selection of low-cost mutual funds and ETFs. Their platforms are easy to use, and most importantly, they have a long-standing reputation for putting their customers first. The key is to choose one with no account maintenance fees and no or low trading fees. Opening an account is as simple as signing up for a new email address, though you'll need to provide some personal information like your social security number for tax purposes. Once you've picked your store, you need to decide which shopping cart you're going to use. This is about the type of account you open. You have two main choices: a taxable brokerage account or a tax-advantaged retirement account. A standard, taxable brokerage account is the most flexible. You put money in, invest it, and when you sell your investments for a profit, you pay capital gains tax on those earnings. Simple. But the real superpower for long-term wealth building lies in tax-advantaged accounts. These are accounts specifically designed for retirement, and the U.S. government gives you incredible tax breaks to encourage you to use them. The most common are the IRA, the individual retirement arrangement, and the 401k, which you get through your employer. With a traditional IRA or 401k, you contribute pre-tax money. This lowers your taxable income today, which is a fantastic benefit. Your money grows tax-deferred for decades, and you only pay income tax on it when you withdraw it in retirement. Then there's the superstar of retirement accounts, the Roth IRA or Roth 401k. With a Roth, you contribute after-tax money. This means you don't get a tax break today. But here's the magic. Your money grows completely 100% tax-free. And when you withdraw it in retirement, you pay nothing. Zero. Not a single penny in taxes on all those decades of growth. For most young and middle-aged Americans, the Roth is one of the single greatest wealth-building tools ever created. If your employer offers a 401k with a match, contribute enough to get that full match. It's free money. After that, prioritize funding a Roth IRA. Okay, you've chosen your brokerage. You've opened your account. Let's say it's a Roth IRA. Now for the main event, choosing the funds. This is where millions of people get paralyzed by choice. But you won't, because you have the blueprint. We're going to build a simple, powerful, and profoundly effective portfolio using just 3 types of low-cost index funds. This is often called a 3-fund portfolio, and it is the gold standard for sensible long-term investing. Fund number 1, a U.S. Total Stock Market Index Fund. This is your foundation. This single fund buys you a small piece of virtually every publicly traded company in America, from Apple and Microsoft all the way down to small, up-and-coming businesses. You are owning the entire engine of American innovation and economic growth. It is the ultimate expression of diversification within the U.S. market. Every brokerage has their own version. At Vanguard, it's VTSAX. At Fidelity, it's FSKX. Fund number 2, an International Total Stock Market Index Fund. The United States is a massive economy, but it's still less than half of the world's total stock market. To be truly diversified, you need to own companies outside our borders. This fund does exactly that, buying you a piece of thousands of companies in developed and emerging markets across Europe, Asia, and the rest of the world. This protects you from a scenario where the U.S. market underperforms for a decade, while the rest of the world soars. At Vanguard, this is VTX. At Fidelity, it's FDIX. Fund number 3, a U.S. Total Bond Market Index Fund. This is your stabilizer, your shock absorber. While stocks provide the high-octane fuel for long-term growth, they are volatile. Bonds are the opposite. They are loans to corporations and governments, providing steady, predictable, but lower returns. When the stock market panics and plunges, bonds tend to hold their value or even go up, acting as a ballast that keeps your portfolio from sinking too low. This stability is what gives you the courage to stay invested during the tough times. At Vanguard, this is VBTLX. Fidelity, it's FXNAX. That's it. Those 3 funds give you ownership in tens of thousands of companies and bonds across the entire globe. You are more diversified than a billionaire who only owns a handful of individual stocks. The final piece of the puzzle is deciding how much to put in each. This is your asset allocation. The key decision is your split between stocks, the combination of your US and international funds, and bonds. This depends entirely on your age and your tolerance for risk. A common rule of thumb is to hold your age in bonds. So if you're 30, you'd have 30% in bonds and 70% in stocks. Another is 110 minus your age in stocks. So a 30-year-old would have 80% in stocks and 20% in bonds. For your stock portion, a common split is to put about 70 to 80% of it in the US fund and 20 to 30% in the international fund. So for our 30-year-old using the 80-20 split, their portfolio might look like this: 60% in a US total stock market index fund, 20% in an international total stock market index fund, and 20% in a US total bond market index fund. Once you have your percentages, you simply go into your brokerage account, type in the ticker symbol for each fund, like VTSAX, decide how much money you want to invest and click buy. And then, here's the most important step of all, you automate it. Set up an automatic transfer from your bank account to your brokerage account every week, or every 2 weeks, or every month. Have that money automatically invested into your 3 funds according to your chosen percentages. This is called dollar cost averaging, and it is your secret weapon. When the market is high, your fixed dollar amount buys fewer shares. When the market crashes, that same fixed dollar amount buys more shares at a discount. You are automatically buying low without ever having to think about it. And then you let it work. You ignore the headlines. You tune out the talking heads on TV predicting the next crash. You stop checking your balance every day. You have built an all-weather machine designed to capture the long-term growth of the global economy. Your only job now is to keep feeding it fuel through your automatic contributions and let it run for decades. You rebalance once a year, meaning you sell a little of what did well and buy a little of what did poorly to get back to your target percentages. That's it. That's the whole job. We've come a long way on this journey together. We started with the simple, confusing question: what even is a mutual fund? We dismantled it piece by piece. We learned about diversification, risk, and the silent poison of high fees. We uncovered the revolutionary power of the index fund, the simple idea that owning the whole haystack is better than searching for the needle. We distinguished between stocks and bonds, growth and value. And now we have assembled that knowledge into a concrete, actionable plan that you can start implementing today. This isn't just financial theory. This is the blueprint for financial freedom. This is how ordinary Americans, teachers, plumbers, nurses, software engineers, build extraordinary wealth. Not through get-rich-quick schemes or risky stock picks, but through discipline, patience, and harnessing the power of the greatest wealth creation engine in the history of the world, the global market. The road ahead will not always be smooth. There will be market crashes. There will be recessions. There will be moments of panic where it feels like the entire system is about to collapse and every fiber of your being will scream at you to sell. In those moments, you must remember this plan. You must remember that you are not a speculator. You are an owner. You are a long-term investor, and downturns are merely sales for those with the courage to keep buying. You have been given the knowledge that, for generations, was reserved for the wealthy and the well-connected. You now understand how this system works better than the vast majority of your peers. The complexity has been stripped away, revealing a path that is surprisingly simple, yet profoundly powerful. The only thing stopping you now is inertia, the belief that it's too complicated, that you're too late, or that you don't have enough to start. All of it is a lie. You can start with $50. The best time to plant a tree was 20 years ago. The second best time is right now. You have the blueprint. You have the tools. You now possess the knowledge to take control of your financial destiny, to build a future not of anxiety and uncertainty, but of security, opportunity, and freedom. The checkout counter is open. Go build your future.